I'd like to welcome everyone to the New York Alternative Investment Roundtable event for March 2023, entitled Busted PE Deal, ESOP to the Rescue. I'm Robert Akeson of the Riverside Management Group, the moderator, and today we are very pleased to welcome Darren Gleeman, the managing partner of MBO Ventures. In the past, Darren was also founder of eCoupons, managing partner of both GMD Trading and GB Trading. Darren is an expert in ESOPs and a prolific angel investor in companies such as Screaming Media, Blackboard, Social Radar, and Accelerant Manufacturing. Darren holds a degree from the Wharton School, where he learned the value of quantitative modeling and the scientific method. He founded a firm that took the human element out of trading, transitioning the company into one of the first high-frequency trading platforms in the world, which traded over 1% of all U.S. equities each day. I think you're going to find Darren's perspectives to be both relevant and potentially very useful regarding private equity and ESOPs, especially in the current market and economic conditions we find ourselves in. Before we dive into this interesting and relevant topic, I do want to thank our sponsors for their ongoing support of the roundtable and this call in particular. And as you can see up on the board, they include Alston Bird, Baker Tilly, Deloitte, Bloomberg, New Mountain Capital, Grant Thornton, Ultimus Leverpoint, and our nonprofit sponsors, Kaya, and the Gabelli School of Business at Fordham University. Just a reminder to everyone, Darren will be answering my questions for approximately 50 or so minutes. We're going to open up to the audience at that point. But of course, as I hope you all know, there is a tool down at the bottom of your screen. You can send questions in at any time. And I know Darren would love to get your questions as you think of them. So by all means, please feel free to send questions in. So let's get to it, Darren. And I think maybe a good place to begin. Can you give us a very brief definition of what an ESOP is to begin with, please? Yeah, and that's right there. That's important. I'm not giving the standard question. You know, what is an ESOP? Well, standard what you would read is an ESOP, or an employee stock ownership plan, is an IRC section 401. I'm kidding, guys, but that literally is how people describe an ESOP. Now, an ESOP, bottom line, is just another way for you to sell your company. That's it. Except when you sell your company via this ESOP, there's huge amounts of tax benefits that go along with it. That's the bottom line, just another way to sell your company. That's it. Okay, terrific. So tell us a little bit about your background in terms of structuring ESOPs. How many have you structured, Darren? So we've structured now over the past 24 years, we've structured over 350 ESOPs. Wow. Oh, yeah, it's a lot. Over $22 billion in enterprise value. And we've structured over $7 billion in ESOP financing. We know the space super well. And I think you do. And you know, one thing that really caught me is not only do you know the space super well, but you're passionate about it. And I've heard you say that ESOPs are not boring and that they are sexy. Those are bold words. Can you give us a little more perspective on that? Yeah, they are bold. You know, people think an ESOP is some type of pension plan. It's not, and it's gotten a bad rap, and that's why, you know, I've been pitching out for years is ESOPs are sexy. You know, not paying taxes is sexy. It's awesome. Let me give you an overview of how the whole ESOP structure works. Please. Right? Okay. So this title of this session is, you know, ESOP really versus private equity. So let's go through, you know, a top line case study. All right. Let's just take a $20 million manufacturing firm. Doesn't matter where it is in the country. I'm here in New York, so it's a New York manufacturing firm. $20 million in net income. You know, in my world, we call it EBITDA. You know, most people call it, you know, net income. So $20 million in net income.
and the value of the company is $100 million, 20 million times 5. Okay. Options to sell your company. You can sell to private equity, you can sell to a strategic buyer, or you could sell to this ESOP structure. Well, number one, when you sell your company to private equity or to a strategic buyer, you got to pay your capital gains tax.
Okay.
Really, no way to get around that, right?
Yes.
So federally, you're talking about 21%, state 6 or 7, then you have Medicare 3.3. Let's say overall, for most states, you're getting hit with about 30%.
Yes.
So for a $100 million company, the cost is going to be $30 million to you. That's a lot of tax. When you sell your company to your employees via this ESOP structure, the taxes are deferred, the capital gains are deferred, and structured correctly, it's deferred forever. That's a huge advantage.
I would say so. So you're saying basically a company that is 100% owned by an ESOP is going to pay zero income taxes forever?
That's correct. So
and let me just ask a follow-up on that too, Darren. So does that also mean when the company owner sells the business, they're not going to pay capital gains?
Yeah. So there's two different types of taxes, and those are two benefits. Yeah.
Okay.
So number one is you sell the company for $100 million, your capital gains are deferred, and you structure correctly, those capital gains are deferred forever. So I don't know if anybody in the audience knows some people will know what a 1031 is with real estate. That's a like-kind exchange, but don't worry about that. In the ESOP world, when you sell your company for $100 million, your capital gains can be deferred. And that means you're not paying capital gains. Upon your death, you get what's called a step up in basis. And what that really means is that your heirs are not going to pay any capital gains at all. So you really go from a deferment to a complete removal. That's actually the capital gains. What you're talking about, the other thing, is if you sell 100% of the company, if you sell 100% of the company, if you sell 100% of the company itself runs completely tax-free. 0 federal tax and 0 state tax forever. Literally no tax. And again, nobody knows this. That's part of the things that make it sexy, right? I mean, that is
absolutely
sexy, right? 0 tax. Can anybody imagine that? No tax. Now, another thing, right? Let's say in the ESOP world, you can sell 20%, 30%, 40%. You can sell whatever you want. If you sell, let's say, 30% of your company, in this example, for $100 million, right?
Yes.
So 30% of it, you borrow money usually when you're actually acquiring companies of this. Let me step back for 2 seconds. With a private equity firm, right? Let's go back to it. With a private equity firm, how do I buy a company that's $100 million, right? So in our example, we have a $20 million EBITDA company.
Yes.
Worth $100 million. So private equity, plain vanilla, forgetting about ESOP, how do I do it? Well, I take $20 million of my own fund and I put it in, and that goes to the owner. That's $20 million. Then the fund goes out, we borrow $60 million based on the company's assets or the company's cash flow. So in this example, it's $20 million in EBITDA. So 3 times 20 is what we can borrow. So go out, we mean being this private equity firm, we borrow $60 million. These used to be called a leveraged buyout. About 20 years ago, we don't call it leveraged buyout, we call it private equity, right? So yes. We go out, remember, we give you $20 million, we borrow $60 million off of the company's assets and cash flow. That's $80 million, which goes to the owner. And then the last $20 million is an earnout or it's rollover equity. An earnout means that as long as you reach milestones that you said you were going to reach, then you're going to get your $20 million. You don't reach the milestones, you don't get that. Rollover equity means that you, as the owner, will roll equity in. So you're going to actually have
Darren, just hold on a second. So I think people in the audience are probably familiar with, many people, I'm sure, are familiar with the earnout concept. So who establishes the earnout here or the earnout level?
Well, in a private equity firm, I'm talking about private equity, not ESOP. In the private equity firm,
I see. Thank you.
Yeah, the private equity firm. Yeah, thanks for clarifying that. The private equity firm would describe how much of the earnout it's going to be. With an ESOP, now the ESOP structure, right? With an ESOP structure, very similar, except there's no equity at all. Remember, in that private equity, put down 20 million bucks. With an ESOP, there's no equity. With an ESOP, we go out, and instead of another company coming in and levering up your balance sheet, you lever your own balance sheet. So you're going to borrow that same $60 million, right? And when you borrow via this ESOP structure, the rate's a little bit better. And I'll tell you why in a minute. So you're going to borrow the 60 million. That 60 million then goes directly to the owner's pocket. Remember, no capital gains tax. And the other $40 million is going to be a seller note, which is an IOU from the company back to the owner. Now, two things with that, which everyone in the audience will eventually come up with, is what lender is going to lend $60 million, right? And when there's no equity, there's nothing tying them in.
Yes.
Right? You can think about that. Well, this is what happens with an ESOP. Remember, I didn't tell you this. The employees, it costs the employees literally nothing, right? This is all a gift to the employees.
Yes.
It's all done, as I'm explaining now, through this leverage, right? Why would a bank do that? Well, this is why. Normally, right, Bob, you go out and you take a loan, or any company takes out a loan in this country, any person takes out a loan, there's interest. And we get to deduct the interest basically when we file our taxes.
Yes.
But nobody can deduct the actual principal of the loan, because that just doesn't happen. They're not allowed to deduct the principal of the loan, except in this one case. When it's an ESOP that's buying the company is allowed to take a full deduction of the entire principal of the loan. So in this example, it's $100 million. So the company can deduct $100 million in addition to the interest on that. That was the original idea of the government. How are the employees going to pay for it? That's how the employees pay for it, by that subsidy from the government. It's huge. Depending on the state you're in, it could be worth between $30 and $50 million to the company. And it's not something you're paying back. That is a big deal.
Absolutely. Absolutely.
So when you put all these few things together, it's pretty amazing the different subsidies the government gives you.
Oh, absolutely. So Darren, let's just pivot a little bit to warrants. Okay. Yep. How do warrants work with an ESOP?
Well, one way, right? What is a warrant? A warrant is it's a right to buy back stock. It's a right to buy back stock, right? It's very similar to an option. So the way it would work, let's use the example that we're in, right? So here we have it's $100 million. We got $60 million from a senior lender, and we did a $40 million seller note. Well, why does anybody want a seller note, right? I mean, do I really want that? Well, in the case of an ESOP, yes, you definitely want a seller note. And this is why. A seller note, by definition, is subordinate to that senior money.
Oh, yes.
Right? So that senior money, which in this example is $60 million, let's say JP Morgan, they're senior. That means if anything happens to the company, JP Morgan takes it over.
Okay.
So that $40 million seller note is subordinate. So if something goes wrong, they're not getting anything. That means they're taking a lot more risk. So if you're taking a lot more risk, you deserve a bigger interest rate, more reward.
Of course.
So let's just say the market return, the market interest rate for those seller notes should be 15%, right?
Okay.
Well, putting 15% onto your company is a little harsh. It's a lot on $40 million.
Absolutely.
So we say to them, look, instead of taking 15% interest rate, you're going to get 5%.
Okay.
But they should be getting 15.
Yes.
Right?
Yes.
All right. So in lieu of that 10% difference, they're going to get these warrants. And the warrants will allow them to buy back a piece of the company in the future. Right.
Of course.
And depending on how you structure it, they can get back 20%, 30%, 40% in warrants. Now, let's say it's 40% in warrants. How does that work? All right. Well, the warrants come with a price, right? When you initiate, it comes with a price. So the predetermined price for you to actually hand these warrants in and get stock back, that's called the strike price, the predetermined price. So
and of course, where would the strike price be? So it's going to be on top of the current price, the current valuation.
Right. That's right. So on top of the current equity, the equity. So,
Yes.
So let's say, right, this company, right, in an example, it's a $100 million company.
Okay.
Right? That's the enterprise value. We just put on, in this example, $100 million worth of debt, right?
Yes.
So that means, by definition, 100 minus 100 is zero. The equity value on day one is basically zero, right? So the warrant strike price is very close to zero. Now,
it doesn't get better than that, right?
Doesn't get better than that. So the strike price for that $100 million company, for 40%, it would not be zero. The strike price would be about $8 million. So that means that at any time, and the time frame about 15, 20 years, at any time next 15 to 20 years, you hand in the warrants, write a check for $8 million to the company, and get back 40% of the company, which today, 40% of the company is worth really.
So Darren, it sounds like so these warrants, unlike maybe I'll use this term, more traditional warrants, don't really have a vesting period. In other words, there's no it's out there forever. The exercise.
Well, the exercise price is at $8 million. The time frame would be of 15, 20. It would have a time. It has a time of 15, 20 years. Most people think of like options as having a 3 months, 6 months, 12 months date.
Right.
A warrants are more long-term, and these are about 15 to 20 years.
Nice.
Yeah, which really is the second bite at the apple for the owners' children, or the management team, who could be also used as warrants.
Yes. And I think you've sort of touched on this, but let me just be clear, or I'd like to be more clear on this. Yeah. How do the employees pay for it?
Yeah, exactly. The employees, it really is a gift. And that it needs to be clear. The employees, if they are not using their 401k, you're not changing their salary. The employees, everything for them stays as is, and they're not part of this process.
Okay.
After the fact, it's, oh, by the way, you are now owners of this company, and it's costing you nothing. So it's not draining their 401k and not draining their salary. It's all paid for, exactly like we were saying, by this debt. It's just a debt-driven transaction. And sometimes, actually, there are companies that don't want to have any debt, and they do all sell a note. That is definitely a possibility. But it costs the employees literally nothing.
Oh, that's very nice. Absolutely. So does an employee automatically become an owner, or is this some type of vesting period that we go through here? I mean, what's the formality of the process like?
Yeah, so every single employee of the company is part of the ESOP. You're not allowed to discriminate. It's called a non-discriminatory policy. So everyone is part of it. Well, actually, you can discriminate against one group, which are union workers. You don't have to, but you're allowed.
Say that again, please.
You're allowed to discriminate against union workers.
And what's that about?
Union workers have their own policies, their own procedures, they're their own world. And in the code, you're just allowed to not have them part of it. And actually, people use the whole ESOP structure. And I have a client right now that is using the ESOP structure for the purpose of saying to the union workers, look, you're not part of this, but look what you get. And the benefits of being part of the ESOP can be, and for this company will be, life-changing. And the way it works is for any company that is any individual that's part of it, they vest into it like a traditional vesting schedule. So they may vest into it over, let's say, 5 years. So you put the ESOP in place today. Next year, they get 20%, 40, 60, 80, 100%. And how much you get versus me, strictly based on salary. So if you earn $100,000 a year and I earn $200,000 a year, I get twice as much stock as you do. If you get 300,000, I have 100,000, 3 times as much. And it's capped out. The government caps out.
It's prorated.
Yeah.
Prorated, but capped. Okay.
Yeah, 310,000, I think, is like the cap. So if I make $1 million and you're making 300,000, I'm still making 10/7 of you. I mean,
right.
100, same as you.
Okay. And so, Darren, when a company has an ESOP, all right, are the employees running the company?
No, that's a big question. And even though I'll explain it to you, people will still they won't remember it. No, the company runs exactly how it runs today. Now, all companies, right, all corporations have a board of directors. The board of directors is what runs the company. They govern the company, right? And the board of directors then appoints the management team, who then manage the company. So the way it works, though, there is a trustee in place. The trustee is the one that actually will vote the shares for the employees. Now, the trustee is an institutional trustee. That means it's not going to be someone that works there. It's not an owner. It's not a manager. It's a company. And there's only a half a dozen of these really that do this business. They have one job, really one job. And their one job is to make sure that the employees pay what's called fair market value. That's it. That's their job. And what's fair market value? Fair market value means they're going to look at the discounted cash flow, the cash flows of the company. They're going to look at private comps and public comps, and they're going to put it all together in a valuated average and come up with a value. So the trustee might say right at the beginning of this company, may say, well, we think the company is worth $95 million, and we think that the warrant package that you're talking about should be 30%.
Okay.
We'll come out and we're working with the owner and say, well, we don't think so. We think this company is worth $105 million based on X, Y, and Z. We think the warrant package should be this. And there'll be a literal negotiation. There'll be a battle between us and the trustees to come up with fair market value. And once they come up with that price, that's what they do. Now, that's their main goal, is to come up with that fair market value. But remember, they are voting the shares, right? They're a fiduciary. So they don't want to run the company. That's the last thing they want to do. They just want to value the company. They want to make sure it's running properly. So running properly means they get the right team. So what they'll do is this. Let's say, Bob, it's you and Britt, and the two of you own a company. What they'll say, okay, guys, you're doing this ESOP. This is what we're going to do. Bob and Britt, you guys are going to get 2 seats of a 5 board member company. You're going to get 2 seats. And you're going to run this seat. You're going to be there elected for 3 years. You get 2 seats each. So remember, 2 seats out of 5. Britt, I want you guys to now give me 3 independent directors that you and Bob think are going to be great for your company. It's going to be awesome for your company. So now, Bob, you and Britt go out, and then you give a slate of 3 independent directors that you think are going to be great for your company, also elected for a term of 3 years. The trustee can say yes or no to that. Let's say they say yes. That is your 5-member board that now will be elected, right? They're for a 3-year term. They're the ones that govern the company, not the employees. I know it's a big, long-winded story about it, but that's not how it's working. The employees are part of it.
And again, this group also is responsible for appointing the C-level executives?
Absolutely. The board they are a board of directors, just like any company. They appoint the management team, the C-level directors. And if you're in the company and you just sold the company and you were the former CEO, 99.9% of the time, if you want to be the CEO, you're going to be continuing to be the CEO. An ESOP even though it's a sale, it's a very gradual sale, and it's usually the owners are staying in for a period of time.
Okay.
They're not stepping out. They're using the ESOP to do other things, but they're not stepping out. As a matter of fact, there's one company I know where the ESOP, the CEO just wanted totally out. Usually everyone wants to stay in. And something interesting about owners, a lot of times owners think they want to actually sail off into the sunset, play some golf, cook some meals, and go traveling. And you know what? After 6 months, they get very bored of that, and they want to come back. And
yeah, so they need the adrenaline rush, the action.
Yeah. I mean, once you're involved in it, people like it. Once you go off, it's like now all of a sudden, you're not the person anymore.
Right.
As a CEO, people talk to you differently. They always assume that you just know better and you know more and you're smarter, which you're not.
So that Darren, that leads me to another question here. Is an ESOP an all or nothing proposition? In other words, can you sell less than 100% of the company to the ESOP, or does it have to be 100%? How does that work?
Yeah, it could be anything. It could be 1% to 100%. Most people set up an ESOP, and the minimum that they do is 30%. Why 30%? Well, there's magic at 30%. So let's take our $100 million example. If you sell 29% of the company for $29 million, 29%, you're going to get hit with a huge capital gains tax bill of $10 million because the line in the sand is 30%, and that's in the code. If you sell 30%, that's where you get to defer your capital gains taxes. And then you can sell 30%, 40%, 50%. And again, based on the structuring, a lot of people that we work with, they'll do multiple stage transactions. And the first stage transaction that they always will do will be between 30 and 49%. Then they will eventually structure into the 100%. But most people eventually get to that 100% because that's, again, where you're not paying any taxes. So if you're not paying any taxes at 100%, why not get there? And if we can get you warrants to buy back 40% of the company, all right, well, why not sell 100%, run this company for 15 years, tax-free, then hand in my warrants? Yeah.
Yes. That's quite a incentive. So, Darren, I think there's no question, based on what you've described here, ESOPs sound like a tremendous opportunity, a tremendous way to build wealth for employees and for even owners of the company, right? But suppose I'm the owner or the principal owner of a company, and I consider the company to be a bit of a legacy, and I want my kids to take it over. How does that work? What can I do in that situation?
Yeah, that is awesome. Because this is how most people do. Most people, again, the $100 million example is a great example. You want to give it to your kids. You're not allowed. You can't give your business to the kids. That's just not the way it works. If you give the business to your kids, you're going to pay gift tax. So you're not allowed to do that anymore. So you have to actually sell it to them. So traditionally, and this is what people do now, and the reason why they do this structure, and their accounting firms and lawyers tell us they don't know about this. This is what normally people will do. They take that company, it's a $100 million valuation.
Yes.
And it's making $20 million a year. We're here in New York. Great. Company, now we sell it to the kids for $100 million.
Okay.
And they don't have the money to pay me $100 million. So they're going to pay me over 10 years, $10 million a year. How does that work? Well, the company makes $20 million. They pay $10 million to the IRS, to New York City, New York State. They come out with $10 million that the kids get. Yay, they have $10 million. Then they take that $10 million and they give it to their parents. Their parents now have that $10 million, and now they pay their capital gains tax of $3 million. So they're left with 7. Year 1, rinse and repeat every year for 10 years. It's very tax inefficient. Right? But that's the most efficient way to do it without the ESOP structure that nobody knows about. Now you put the ESOP structure in place. We sell the company 100% to the employees.
Okay.
Right? Day one, the parents will get $60 million. Remember, they're not paying capital gains tax. They're going to be able to defer that, right? Day one, they get $60 million. Remember those warrants we were talking about? Well, those warrants for 40% of the company were gifted to the child. On day one, they were gifted to the child. Now, let's go back. Those warrants on day one, remember, the value of those warrants were basically zero. The strike price we were talking about earlier was about $8 million. The value is almost zero. The value is nothing. And that's because equity on day one is nothing. Remember, if you have a $100 million company, we put $100 million of loans on it.
You said that before, yes.
The equity is zero, so the warrants are zero. So the value of those warrants is zero. You take those warrants and you put it inside a trust. And when you put it inside a trust, great, it's worth nothing. Now it grows inside the trust as that debt is paid down. And as it grows inside the trust, you then can also remove estate taxes. So that's a little bit more technical, but that's also a great thing. Anyway, so the children now get these warrants for 40% of the company. Parents, day one, get $60 million. The debt is paid down at $60 million in about, let's say, 3.5 years. And by the way, if this company is growing and is doing fine, the banks, after a year or 2 years, will come back to the parents and say, oh, you have a $40 million seller note? We'll take that out right now. They do that a lot. And that means the parents will be made whole at $100 million within, say, 3 years. And if they don't do that, they'll still be made whole in about 5-6 years. $100 million with no capital gains tax. And the children now have those warrants, right? So now, after year 5 or 6, the company now is running completely tax-free, making $20 million a year, paying no tax. Well, the kids can take that $20 million and expand the company. They can buy other companies. And when they buy other companies, what happens? Well, there's also magic. The moment I acquire another company, all the net income from that company accretes to us completely tax-free also.
Oh, that's awesome.
So it's a huge advantage. I need some more equipment from a manufacturing firm. I have that much more money to do it. Now you're looking at, by year 12, 13, 14, the kids, unless they wrecked it, the kids should be able to take this company and make it a much larger company than if they were doing that traditional structure they were doing with the parents originally, the installment note system. It's a much better way of doing it.
And I think we touched on this a moment ago, but if you can just refresh the audience and myself.
Yeah. Again,
the price of the company when the ESOP buys the company, who has that decided again?
Yeah, that's a good question. So normally, right, an ESOP can pay, it's called fair market value. That means it's kind of the price that a private equity firm would pay.
Yes.
Because a private equity firm is a financial buyer by definition, right? It's financial engineering. So we know in this example, it's a $100 million company. It makes $20 million a year. Well, if I put $60 million of debt on the books and my interest rate is 6% of the $60 million, well, that's $3.6 million plus the amortization. I have to be able to pay it back. If I can't pay back that loan and do the actual math, it's not going to work out.
Okay.
So that's how a financial buyer decides to buy. A strategic buyer, right? They're not looking at that. A strategic buyer is, let's say, IBM, that's going out and they want to buy this small computer infrastructure company. They know that they want to be in whatever, Chattanooga, and they want to be in a certain area, so they don't care. They're going to pay a premium. They can pay 20 times EBITDA. They don't care. They're going to pay a premium. With an ESOP, you're not allowed to pay any premium.
I'm sorry, repeat that, please.
You're not allowed to pay any premium. It has to be based on that fair market value.
Okay.
That's it. And the fair market value is what a private equity firm would pay. And so that's usually based on financial modeling. So you're using a discounted.
So it's governed by GAAP and IFRS guidelines.
No, it's not really GAAP or IFRS, but you are using that. It's really guided by, it's a nebulous term, and you that question is very, very much inside the ESOP community right now. Is what is fair market value?
Right.
And I'll tell you, the Department of Labor has never come up with a structure to determine what is true fair market value. So the way we'll decide, and we've figured it out, is through lawsuits. Now, on December 31st, 2022, a new law came in. And the new law dictated to the Department of Labor that you must now give a structure to what you are calling fair market value. Because there's nothing to it. There's no rules to it. So they have to put a rule to it. The rule that everybody uses is the discounted cash flow. We look at private comps and public comps.
So Darren, just out of curiosity, who is if there's a problem with the valuation, who's on the hook for that? The board?
No, the board is not on the hook for that. The fiduciary, the trustee, is on the hook for that, not the company and not the employees.
Okay.
So that's why, and as a fiduciary, they have to be sure, because it used to be about 6-7 years ago, there were a lot of lawsuits. It was just the DOL would just willy-nilly do lawsuits, and about 3% of all companies were being sued or audited by the DOL. That's calmed down in the past couple of years, though, just because I think they're thinking more about it.
Okay. And how many, rough estimate, how many ESOP plans are there out there today in the United States?
About 6,500, rough estimate.
Really? Yeah. I mean, based on what you've described here, I mean, it really sounds like an awesome program. As we said, for both, wealth, for really all aspects of wealth creation, for really all the participants. Yeah. So why aren't there more companies doing this then?
It's pure education. That's it. Nobody knows. What they do know normally, like, hopefully, people are staying with me. I'm not boring them to death, and I don't think I am. But again, normally, people will say, well, they will talk about this. And I'm having an interview with you and say, Darren, what is an ESOP? And that was the first question you asked me. And I'll say, well, it's an IRC Section 401A qualified defined contribution plan. That's a stock bonus plan. It's also a money purchase plan. And yes, it's designed to invest. And literally, and I've been on so many panels. I like to be on a panel with those people because then it makes me, the Superman. But that's how it's described. And so no one understands it. And for some reason, when people talk about ESOPs, they start getting into code. They literally start talking about IRS code. When I'm describing PE and I come in and say, Bob, I want to buy your company. And I don't tell you, well, what I'm going to do is I'm going to structure this as an asset sale based on section 497B. I don't say that. I say, I want to buy your company. I'm going to pay you $100 million. With an ESOP, for some reason, almost everyone goes in and talks about, well, here's an issue with this. This makes it complicated, and this is the code. And then no one knows what they're talking about. Also, you heard how good it is, right? It sounds too good to be true. It is. Okay. It's subsidies. It does sound too good to be true. But hey, we mail. If you think about even mailing a letter, and I take a letter that I can mail from New York City and I can mail it to California in the mail, and I can put it in. I don't know what a postage stamp is now, but it's like, I don't know, 20, 30 cents, and it somehow is going to get there. Yeah, because it's subsidized. It's the same thing with this plan. The government completely subsidizes it. And it's the best, it's really the best thing in the world that the government has done. It really aligns the employees and the owners.
So let me ask this, is there a minimum size ESOP?
Yeah, I mean, you could do, any company can really do it, but it doesn't really make sense if you're too tiny. So I like to say is the minimum, the floor is about— I'm
sorry, minimum of what?
The minimum net income. The minimum net income / EBITDA would be about $2.5 million and 20 employees.
What would the line items of the costs be for setting up an ESOP?
So to set it up, you have investment banking fees, you have the company counsel, you have the employee the employees have counsel, then they have a valuation firm.
Okay.
Yeah, it's just like a private equity deal, just a little bit more, but it's the same fees as private equity.
Okay. So there's an economic breakpoint, so to speak, that dictates whether you're going to do this or not. If it's too small, the cost will exceed at least the short-term benefits, and it doesn't.
Plus, when we go out, right, we borrow money for the company to buy out the owner. Well, we never will take we'll have the owners personally sign for it, ever. That's just not how we work. Now, a lot of companies will do that, but we don't like that. I mean, the person selling, they don't want to have to take that additional risk. Now, if you have an EBITDA that is less than 2.5 million, it's hard for a bank or another lender to come in and say, okay, I won't need a personal note. Now, a bank, if you go into a bank, no matter what, you could be a $30 million EBITDA company and you want a loan, the bank is going to ask you for a personal guarantee.
Right.
They're just going to ask you. Now, with us, yeah, they can ask it, but we know, nope, they just close the door on them. So they already know, well, that's a non-starter. And when you compete with all these banks and all these lenders, that's how you get beyond, the certain covenants that they want.
Sure.
But that covenant they'll always want. And if you're too small, they're not going to give you, it'll be difficult for us to even go in and ask it.
Yes.
That's another reason.
So let me ask you this then: Are ESOPs good for again all companies where the economics are right, or are there certain companies or certain sectors that are or companies with other attributes that let's say lend themselves to a more favorable outcome for the ESOP and for the participants?
Yeah, I like to say that I like to give the knots. What's it not good for? Well,
okay, what are the knots?
The knots, like this whole thing with Chat GPT, right? With this artificial intelligence that's in the news right now.
Yes.
Those companies that are in now. By the way, I'm getting in my inbox. I'm getting so many companies, so many investment bankers are pitching me. Oh, we have this artificial intelligence company that we'd like you to look at, which is most of them is BS. But artificial intelligence, because there's so much premium in that, you're not going to get a normal multiple. It's all premium, and that's something that is not good. Someone comes to me for artificial intelligence or robotics, and I'm like, no, that's venture capital, right? Those are way too high premiums in it. An ESOP is for everything that you look around or do within a week. Within a week, you look around. Like I'm looking outside my apartment here in New York City, and I see buildings. Well, construction, great. I'm drinking out of this glass. Manufacturing firms. I'm going to the dentist tomorrow. Dental firms are great. Staffing firms are great.
So would you say it's true that, let's say, it's more appropriate for companies that are involved with hard assets or annuitized revenue streams?
Yeah. I think that's a good way to think about it. Restaurants are good. I'm thinking of these clients, and I'm getting
restaurants.
Restaurants are good. Yeah, I had this restaurant chain down south, and they have about 20 restaurants, and they want to do it, and they're doing it. And it's interesting what motivates different people. And there's 3 partners there, and one partner is motivated because they really want to align the employees with the owners, and one guy he really wants to get out. He wants to cash out, and this is like a perfect way that aligns everything. So yeah, the companies that are good are just.
Hold on. That's an interesting point. Okay, just go back to that. So let's say there are that hypothetical example you gave us before, the $100 million EBITDA company or valued company has 3 partners, and one of them wants to exit, and there's no ready market for it. You're saying this is a good way to do that.
Oh, it's a great exit, because let's just say that they do want to exit. There's so many different ways that you can structure it. You can sell, let's say you can sell 49% of the company, where there's 3 partners, let's say they're all equal, where one of the partners will now exit and sell, they're out at 30%. The other 2 partners will split the other 19%, and they'll each take 9%. That was a structure that they originally wanted. We didn't go for that structure, but that would have been fine. The structure that we're actually doing with them is going to be a 49% sale, and they're each equally going to sell whatever it is, like a 16% each. Yeah, it's a great way for people to cash out that way.
Interesting.
As a matter of fact, private equity firms. I don't know if you have any private equity people listening to this, probably not, but a private equity firm is structured as a management company. The management company that's where they get their fees in, and they get that 1.5% or 2% fee every year. Well, no one's buying these management companies. Well, no one was. There's a company that came out called Dial that started buying these firms about 15 years ago. And they started.
What was the name of that company?
Dial, DYAL.
Oh, yeah, sure. The Neuberger Berman. That was actually spun out by Neuberger, wasn't it?
That's correct. They started at Neuberger Berman, and then he just recently did a SPAC like 2 or 3 years ago with Blue Owl. And now they have $130 billion of assets under management. And what they do is they go out and buy 30% of the management companies of these larger private equity firms. Well, what if a private equity firm doesn't want to sell 30% to Dial? Well, why not sell 30% to the ESOP? They get the cash. Now, the founding partners will get the cash, right, up front. They get 30%, which they're not paying the capital gains tax on. And now the management company can take a full deduction of that 30% when they borrow it.
Right.
I mean, it's huge. And now you're also aligning the limited partners, the general partners, along with the employees. It's a great idea if any private equity people are out there.
Interesting. So Darren, your firm, MBO Ventures, okay? So you invest in these ESOPs and you also structure them, okay? Can you tell us a little bit about that? Your experience there with that, or just what it is you're focused on in the space?
Sure. So my firm is, I like to say we're an independent company. We're a private equity. And we only use the ESOP structure. And we work exclusively with CSG partners, CSG Corporate Solutions Group. CSG is one of the largest ESOP investment banks in the nation, also located here in New York. So what I really am doing is I'm out there hunting for companies. I go and I educate the owners of what it's like. And if we find a company that the management team wants to take over, we will back the management team. So let's say a great example of a $100 million company, right? We can raise 60 million in senior and there's 40 million in seller notes. Well, instead of that 40 million in seller notes, we'll say to them, look, we'll put up, let's say $25 million, give that check, write the check of $25 million. So the owner gets that $25 million. And then we will get a part of those seller notes, part of the warrants, sharing it with the management team. So if it's 40% warrants, I'll get 20% warrants and the management team will get 20% warrants. Something like that.
Okay. So let me ask you a sort of a broad brush kind of question. Are ESOP employees better off financially than the employees of non-ESOP owned companies?
Oh, there's massive statistics on that, and it's no comparison of how much better they do. Especially for minority workers, the statistics they have are it really is. It's insane how much different it is. So the average worker, I think in this country makes about like they have about $35,000 in their retirement accounts, about 35 grand.
Yeah. Okay.
The average ESOP has about 135,000.
Wow.
It's huge. And then for like minority women, for Black women, the statistic is their average amount of money that they have is literally nothing in the bank. They have no savings.
Right.
Everything is they pay their rent, paying school, paying everything. The average Black woman that works for an ESOP has about $35,000 in savings.
Wow.
It definitely shrinks the wealth gap. It makes a dent. It's not doing what it should be doing, which we all want to get there, but it's making a huge dent. And the same thing for other minorities. It really is tremendous. And in the right ESOP, not only is it life-changing, it could be generational change. So I bought a company 8, 9, 10 years ago. And we structured it immediately as a 100% owned ESOP. Why? We don't pay taxes, right? We took the owner out, the owner left, went up to the sunset. We just took that company private. This is about, I guess now, 8, 9 months ago. Just took it private. The average employee made about $800,000 that went into their retirement account. And when it goes to their retirement, they don't pay capital gains from that either until they take it out. So for these people, and they did is they washed out these metal bins. That's what they do. And they transfer bins from one state to the other. It's not life-changing for them. It is generational changing for them because now they can buy a house, take kids to college, generational changing. So I am a huge believer in this. So for the employees, it's awesome.
And Darren, what about employee retention at ESOP-owned companies? What's that like? How is this good news reflected in that?
Yeah, so
or not?
Once the employees understand what's going on, because at first it may take about a year to kind of get what's going on. At first, you're part of an ESOP. Okay, it depends on how good you are at explaining it, but once they see their account, and they will see it, especially when we do these deals, they see their account, it makes a difference. Now, the statistics show that retention is about 300% greater for ESOP-owned companies than for traditionally private equity-backed companies.
Wow.
It's huge. Yeah, because what happens is they get it. They are owners. These people will also work harder. Now, the productivity increases also for ESOP companies. ESOPs work. It works on every single level. And yeah, so the employees, they do not want to leave once they realize what it is.
Sure. And Darren, you have certainly made a very compelling case for ESOPs here. What's the downside? What can go wrong with ESOPs?
I guess the downside is, remember I said earlier, we're talking about the Department of Labor. Well, the Department of Labor now, if you have a 401k, the Department of Labor is the company that is going to be regulating the 401k. So
Yes.
Now the Department of Labor is regulating the ESOP. So they can come in and do an audit, and they can come in and say, remember, that $100 million valuation? No, we don't agree with that. We think the valuation should be $95 million. And then you can get caught up in this audit, and what'll end up happening is you can just fight it, or you can eventually say, all right, well, this is now the trustee who's fighting it. The trustee can say, all right, I'll give an extra $200,000, and the company will kick in that goes towards the ESOP. That's really the worst thing that happens with an ESOP is that audit. Okay,
so what's the track record been for situations like that in the past? How often have we encountered these types of situations?
It's like I said, it's very infrequently. It's about 3% of the time companies will get audited. Now it's actually been less. In the past year, I'm not really sure how many have been doing it. We don't have the records yet, but anecdotally, it's gone away in the Biden administration. Pretty much it's gone away. And now with this new rule coming in that they have to explain exactly the process to figure out fair market value, it's probably going away, which is it's a good thing.
Interesting.
Yeah. Another thing, again, if you are a high flyer, the robotics company, it doesn't make sense to do the ESOP. And as we said earlier, if you're too small of a company, it doesn't make sense to do an ESOP. If you also have too much debt on your books. So if you're a company and you already have debt on your books, like private equity companies, they already put tons of debt on their company. So then if they want to sell to the ESOP, well, no, because now you're saddling the employees with tremendous amounts of debt on that books, which no one's going to do it. So the best companies are ones that have very little debt and a nice, good positive cash flow.
And Darren, where do you see this going in the future? I mean, what's the trend in terms of, let's say, ESOP penetration?
I think I'm doing a great job in marketing it. I think
I have no doubt.
Yeah, it just depends actually on getting. Usually, it's law firms, accounting firms, wealth managers to come in and say, "Take a look at this." And a lot of it is they have preconceived notions of what they think an ESOP is, and most of the preconceived notions are it's some type of pension plan. It's complicated. I don't really know what it is. Let's just not worry about that. You already have a 401k plan. So it's really overcoming that. And as taxes increase, it always becomes a better thing for ESOPs because now they're like, there's something with taxes here. Let's talk to these guys.
Right. So if I just maybe take a different approach to that question, is the trend toward greater ESOP participation in the economy or less, or is it fairly static? Are we seeing more ESOPs being launched?
No, I think it's pretty static. I mean, I know people talk about, they feel like there's more about it, but no, it's fairly static every year.
And so
about 250 a year.
Okay, so and you believe that largely that, let's say, lower again, given the positivity of the story, right? That it's a relatively low penetration.
Oh, it's tiny because every industry is geared towards private equity. I mean, I speak with attorneys, accountants, wealth managers all day long. Top people, they have no idea how it works. They have no idea. And I'll speak with ERISA attorneys that they're ERISA attorneys. but they never really get what's actually happening because they're so stuck in the weeds, in the code. It's all education. So that's why it's such a small penetration.
And Darren, I think ESOPs themselves have been around for about 70 years?
ESOPs have been around, I guess, contractually, they've been codified in 1974.
Oh, that's it? Okay.
Yeah. But since the 1950s, this private equity guy, Louis Kelso, is the one that actually started it. So, yeah, since the 1950s.
Okay.
So, yeah.
So Darren, we're coming up on the end of our hour here, and I just wanted to ask you if you had any closing comments you'd like to make. I do want to call everyone's attention. Up on the screen, we do have Darren's contact information, and we strongly encourage anyone that has questions or would like to reach out to Darren. I see Darren's email up there. But Darren, in our remaining couple of minutes, are there any other themes that you'd like to reinforce here?
Well, I assume that the people who are on this, that will be watching the recording, will be advisors. So, yes. Yeah. So I would just say, reach out to me. You can just email me. You can reach out to me through Bob. My phone number is 646-734-2035.
One more time. Give that again. One more time, Darren.
Yes, 646-734-2035. I can educate you, go through it with you, answer all your questions. And in terms of speaking with clients, this is all I do. I speak with clients. I do not sell. I just completely educate, because it either sells itself to you or it doesn't. Some people love it. Some people are like, okay. Most of the people that I speak with, they kind of love it because they didn't know that it was as good as it is. People had no idea.
And I have to say, I'll speak for myself here, Darren. I've been aware of ESOPs, but I really didn't understand them. And I think that this has been a very, very interesting hour for us. I suspect many people are also equally out there in terms of, let's say, not having the detailed knowledge and in terms of understanding what the benefits of an ESOP are. And we really do appreciate your expertise and your insights on this very important topic. And again, do encourage everyone to reach out to Darren. You see his contact information up on the screen. So Darren Gleeman, managing partner of MBO Ventures, I do want to thank you on behalf of the roundtable for sharing your insights and experience regarding ESOPs. This is a very important topic. And I have to say, I'm scratching my head myself, wondering why there aren't more companies doing this. So it
is amazing, right? But again, people hear ESOPs, it's just you automatically roll your eyes. It's almost like, people don't like to talk about certain things like pension plans. It's just boring. Health insurance is just boring. So they think of ESOPs as boring, and it really is not.
No, this is exciting.
Yeah.